program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Friday morning. We are the 28th of November. I'm Nadine Blaney. So sentiment remains upbeat on this week's key theme, which is, of course, bets the U.S. Fed will cut rates next month. This week, Monday to Wednesday, the Nasdaq was up by 4.1%, the S&P 500 increased by 3.1%, and the Dow put on 2.5%. Fed odds have climbed to near 90% that there will be an interest rate cut next month. But of course, overnight, we did have U.S. markets on holiday for Thanksgiving. European stocks edged up on that, improved sentiment, but fair to say activity was subdued. In company news in Europe, two Chinese sportswear firms are reportedly considering a bid for the struggling German brand Puma. Shares jumped as much as 15% on reports suggesting Antisports and Li-Ning may team up with private equity to take Puma over. Meanwhile, Remy Cointreau's CEO said that he'll lower the price on cognac to sell more product, telling the market the worst is over in its key U.S. market. And JP Morgan will build a tower in London's Canary Wharf. The building is set to be one of Europe's tallest towers. Well, JP Morgan's London build commitment comes as the UK continues to digest the country's latest budget. The budget plans to lift taxes by £26 billion. Elsewhere in Europe, an ECB policymaker said it was too early for the central bank to discuss another rate cut, with inflation still a key concern. And in Germany, consumer sentiment got a bit of a lift, with people saying they're likely to spend on Christmas gifts and celebrations. The US dollar index was little changed on day in holiday thin trade. Bond yields were little changed as well, and the Aussie consolidated around 65.3 after yesterday's capital expenditure data here came in much stronger than expected. Bitcoin edged up on that improved investor sentiment. And just to reiterate, the US 10-year hit 3.99%, which was down by just 0.01. Now, Ukraine-Russia talks remain in focus. Oil prices settled higher on low volume. Brent settled up 21% to $63.34 a barrel. Gold slipped, though, from a near two-week high, down by 0.2%. Copper fell 1% after weak Chinese industrial production numbers that came through yesterday. And iron ore rose just slightly to $107 per wet metric ton. So let's get across what we can expect now that Americans are on holiday, although they will have a half day's trading. Isaac Poole from Oriana Private Wealth joins me now. Isaac, what a treat to see you on a Friday. Thank you so much. Obviously not a lot to read into, the action that we saw in terms of U.S. Treasuries, but where do we sit right now with that yield below 4%?
Yeah, we're seeing that yield continue to trend lower. It has been quite volatile on that path lower, but as markets have become increasingly convinced that the Fed is going to cut in December and deliver more cuts next year, you can see the downward pressure on treasuries, which is really different to the discussions we were hearing about maybe 2 or 3 months ago about bond vigilantes coming back and putting pressure on the Fed and putting pressure on the US government to rein in their spending. That talk has completely disappeared, and now it's all back to the Fed and bets on for big rate cuts.
Are those expectations for a rate cut coming in December justified when you consider the data that we've been getting so far is quite stale? Fed speakers are in a blackout, and some even commenting that the Fed Governor Williams' talk, which has increased chances of a rate cut, was a bit stale as well.
It is interesting. I think the trend for a lot of the economic growth has been weaker. The labour market shows unemployment increasing. We're seeing retail sales weaken a little bit. Inflation is sticky though, and that's putting downward pressure on the ability of households to keep spending. And all of that suggests that that there would be a justification for a rate cut in December and further rate cuts next year. But I don't think it's as clear cut as the market is trying to make it. And there's a real sense, I think, that the markets are trying to bully the Fed into this rate cut, really forcing them to take a different view if they dare. I don't think they will dare. I think they will cut. But now the risk is, with all of this priced in, that the commentary that comes out of the Fed will probably not be as dovish as the market is priced for, and that could cause a little bit of volatility going into the end of the year.
Okay, so volatility going into the end of the year. What does that mean? Where are you looking for that volatility to be expressed?
I think you could see it in both in bond yields, which sitting around 4% for the US 10-year Treasury. That's around fair value, we think. There's some downside risk, and that means that it can still provide some good resilience portfolios, but there is also some upside if inflation continues to be sticky. And if we see that upside in Treasury yields, it's really going to challenge equity markets where valuations are really fully priced. And if we don't continue to see the risk-free rate grind its way lower, I think that's going to put some pressure on valuations, which are just so stretched relative to history. So a real chance we see cross-asset volatility pick up and individual asset volatility increase as well.
All right, so if you're given that as the backdrop, where and how active are you being right now?
I don't think this is a time for heroic bang the table calls within portfolios. Most investors in multi-asset portfolios will have a target allocation. We think building some resilience, taking a little bit of risk off the table, not chasing rallies, adding a little bit to shorter duration government bonds, steering away from low quality credit, low quality equities. All of those are sensible ways to manage portfolios, reducing the beta to the market if you don't want to reduce allocations to risk. So perhaps taking value rather than going into growth, perhaps taking the index in bonds rather than chasing a high yield, which has delivered good returns. These are good ways to build some resilience against that volatility, diversify against these big one-off events like the Fed call, the Fed meeting in December. All of these will be good moves, we think, for investors heading into 2026.
All right, so you're optimistic that the bond vigilantes won't be, coming out of the shadows as we move through what is a quieter period, while it's positive often for equities in this sort of Christmas post-New Year period. It is very quiet. I mean, you don't think that that could initiate some further sort of volatility and questions over the fiscal position in the U.S. in particular?
I think that perhaps as we get less data, we come into the Christmas period, it's time for a lot of analysts out there to take stock of the year and think about the risks for next year. And very definitely the U.S. fiscal largesse and ongoing spending will come back into focus. And I mean, we may very well get those bond vigilantes back, especially if inflation pushes a little bit higher. These are, I think, real material risks coming into the end of the year. And I think even more so, after the Fed meeting, we will get the labor market data and we'll get the inflation data. The Fed will be flying blind into that meeting. I think they will take an insurance cut. And it's quite possible that the unemployment rate numbers will really justify and validate that, because I think we're seeing a grind higher. It wouldn't be at all surprising for me to see that unemployment rate really push up in the next couple of months. And that could spook markets as well. While it may justify and validate further rate cuts, I don't think it will leave equity markets, who are expecting strong growth, feeling very positive.
Just a word on Australia, Isaac. I know that you're very globally focused, as is this program. However, global traders and investors are watching the situation here. We've got strong economic data coming through. We've got hot inflation as well. That is what I've read over and over and over, a very unenviable position for the RBA to be in.
Very uncomfortable and very challenging, I think. when you see the unemployment rate grinding higher, but inflation just going in the wrong direction, it's not surprising, I think, that the consensus is moving away from rate cuts towards either on hold and now we're seeing pricing for rate hikes. And that's something for, I think, Australian investors to really focus in on. Not so much the direction of rates, because that they're offering decent yields at the moment. And if there's even if there were to be a couple of rate hikes, still not a bad place to park some money. Where you should focus in on is the Australian dollar, which is just not been moving as high as quickly as the consensus would have you expect it to. And that's because I think while interest rate differentials favour the Aussie dollar, the US dollar broadly has been stronger than expected. I think it's getting flows back in there from global capital. And at the moment, the Australian dollar is not being driven by interest rate differentials. It's being driven by US dollar strength, and in particular, US dollar strength versus Asian currencies. And that is something to keep an eye on, because it's pointing towards downward pressure on the Aussie dollar. So for us, that means just be careful with your hedge ratios, stick around your neutral setting. Don't go trying to lock in big changes in your hedge position right now.
Got it. Okay, that is very clear. Isaac Poole from, oh my goodness, Oriana. No, it's not Oriana. Oh, Oriana.
Ascalon Capital.
Ascalon Capital. That's what I was going to say. It's not Oriana anymore. My apologies, Isaac. We will fix that up. All right. It's a Friday. That's my excuse. That's my excuse for everything on Fridays, just the fact that it's a Friday. Okay. Just quick check-in on the markets before we go. We're expecting to see a bit of a dip at the open, off by 26 points. Dare say it'll be pretty low volume. Keep in mind, though, the market, as we stand now, prior to the open, is up about 2% for the 5 trading days, or 4 trading days so far. So there you go. Make of it what you will. Juliet Sally, my colleague, will bring you through the first hour of the open next.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in Trusted Advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.